Hey there! This is going to be a mini lecture on the topic of economics of wind power, where I will be focusing on the various concepts used within this sub-discipline. This will be a mini lecture in the course WIND100 Introduction to Offshore Wind Power Energy. It's going to be very short, only 20 to 30 minutes. But if you want more of me, I have my own courses in the study program of Industrial Economics. I teach IND 510 Project Management, and I also teach IND 550 Project Cost Estimation and Risk Analysis. But without further ado, let's jump into my contribution to WIN100. Hey there, hello, Sindre here, Associate Professor of Industrial Economics. Offshore wind is an industry, so let's talk about the economics of offshore wind. Let's start with the discipline of economics. Economics comes in two major flavors, two sub-disciplines. These are business economics and societal economics, which can also be referred to as the shareholder perspective and the stakeholder perspective, or as financial appraisal and economic appraisal. Now, this distinction matters because a project or investment can be profitable in terms of one perspective, but unprofitable in terms of the other perspective. Now, we as a society, we would like private companies to undertake projects and investments that are profitable from the stakeholder perspective, good for the society. However, companies base their decisions on what is good for them, based on business economics, based on the shareholder perspective. So if we want to make sure that companies do projects that are good for society, then we as a society need to make sure that these projects are good for the company. Otherwise, they will simply not undertake such projects. Now, both business economics and societal economics are very important, but my expertise is within business economics. So in this lecture, I'm going to focus on the former rather than the latter. Now, if I had to reduce the entire subdiscipline of business economics into just one single metric, then that would be net present value. Net present value is the way that we measure business economic profitability, and it is how businesses and companies decide whether or not to undertake a particular investment or a particular project. And the way it works is that for every single time period or every single year that the investment or project is ongoing, we calculate a cash flow. A cash flow in time period T or in year T is just the difference between the cash inflows during that year minus the cash outflows during that year. So essentially just revenues minus costs, essentially. So what we do with this cash flow is that we divide it by 1 plus r to the power of t, and then we sum up this so-called present value across every single year of the project. Now, essentially, net present value is a slightly more complicated type of cost-benefit analysis. In the end of the day, the sum of the revenues needs to exceed the sum of the costs. But what makes net present value slightly more complicated than the standard cost-benefit analysis is this divide by 1 plus r to the power of t. Now that is called discounting, and the r parameter, that is called the discount rate. Now the discount rate can be somewhat complicated to wrap your mind around initially, because it represents quite a few different concepts. It represents the time value of money, cost of capital, the alternative cost, and the earning potential of capital. The discount rate. How is it calculated? Well, we can use the weighted average cost of capital equation, or WACC for short. What you do is that you take the cost of debt and multiply it by the proportion of debt, and then you add on the cost of equity multiplied by the proportion of equity. And you can, of course, adjust for the tax shield by multiplying the first term of this expression with 1 minus the corporate tax rate. Now, all of the input parameters here are well known. We know the tax rate. You decide yourself how much debt and equity you want to use to finance your project. And the bank that you are borrowing the money from will usually tell you exactly what interest rate they expect in return. Now, the only real unknown here is the cost of equity. So how much return do the investors of the company expect? No, they don't really say that outright. They vote with their feet, so to speak, so we need to estimate it. And that can be accomplished with the Capital Asset Pricing Model, CAPM or CAPM for short. Now this equation has its own set of input parameters. Most of them are well known. The risk-free is well known, and the return on the market portfolio is we use a proxy there essentially. What we do, we take the average return of the stock market where each asset, each company stock is weighted by how big the company is, but just the expected or average return of the stock market. The major unknown here though is the beta coefficient, and that is a measure of systematic risk, and that needs to be estimated also. And to accomplish that, we can use a univariate, simple, ordinary least square regression analysis. So we regress the stock return of some company on the return of the market portfolio, and that will give us the beta coefficient. Now, it is common practice to take this beta coefficient, which is called unlevered, and lever it by this expression shown here on the screen. And there again, the inputs are well known. It's the corporate tax rate, and it's the amount of debt and equity funding the company itself. Well, previously in the CAPM model, in the WACC equation, we looked at the funding of the project. So that is essentially how you calculate the discount rate, and it is. All things considered, it is relatively forward and not that much controversy or contention when it comes to it. But there are a couple of things that we have to use proxies because the real variable is kind of unobservable. So basically, this discount rate represents to us the cost of borrowing money, borrowing from the banks and borrowing from the investors. So in order for a project to be profitable, the profit needs to exceed the cost of the capital. That's the essential idea. So what happens when the discount rate increases is that the net present value of the company tends to decrease. So a common metric here derived from net present value is called the internal rate of return, and that is the discount rate which turns the net present value equal to 0. So that's a common number or metric also used in the public discourse that you should be aware of. So that was the discount rate. But remember, from the net present value equation, we need two inputs. We need the discount rate, and we also need to know the cash flows. So let's look at that next. Depending on how you slice and dice it, there are four main types of project cash flows. These are, number one, the capital expenditure, which is how much it costs to construct and build the offshore wind farm. Then there is the OPEX, or operational expenditure. That is how much money it costs to run and operate the wind farm, and how much it costs to maintain it, to do maintenance. And then there is the decommissioning cost, which is how much it costs to take it apart once we reach the end of the lifespan, when we are done using the wind farm. And then finally, there is the revenues. So three of these are costs, and to estimate cost, we can use what's called, somewhat tautologically, cost estimation. Cost estimation techniques in order to estimate CAPEX, OPEX, and decom. And there are many different types of project cost estimation methods. According to Project Management Institute's Project Management Body of Knowledge, which is a collection of best practice, there are 10 different methods. But this is a bit of an exaggeration, because many of these methods are actually the same in disguise, and some of them are not actually independent cost estimation methods. But among these 10, In my opinion, as an academic, the most theoretically robust approach to estimating the costs, that is called parametric cost estimation. And in parametric cost estimation, the goal is to establish some kind of cost estimating relationship, CER. Now that is a function. So the y in this function on the left-hand side of the equation side, that's going to be the cost. It could be the capex, it could be the opex, it could be the decom. Doesn't really matter. On the right-hand side of the equation side, we have a function which is populated by a set of different parameters as a functional form, and there are some cost drivers. Now the way to choose the cost drivers, that's a whole methodology on its own, but when it comes to offshore wind farms, the literature has mainly settled on 4 cost drivers. That is the ocean depth, how deep is the waters where you're gonna situate the wind farm. What is the distance to shore or the distance to the harbor, and also the size of the wind farm, the installed capacity, the nameplate capacity, how many megawatt or even gigawatt of power I'm going to install, and also there is the capacity of the wind turbine generators themselves. So that is something that is decided outside the model, which variables or cost drivers to put into the model, and it is to a large extent based on subject matter expertise. But what about the parameters? How do we decide them? Well, here there are many different ways. You can use your gut feeling, of course, or expert judgment, as we like to call it. But you can also use a more data-driven approach. If you have data on previous similar projects, you can run what's called a regression analysis, which is actually what we did already when we were calculating the beta coefficient in the capital asset pricing model in order to calculate the cost of equity in the weighted average cost of capital equation to get the discount rate. So we already done a regression, but that was a simple regression. We can do a multi-variable regression or multiple regression. We can use this ordinary least square estimator to figure out the beta coefficient. But this is basically just a data-driven approach. We can do some empirical modeling, do some statistics in order to estimate what the values of these coefficients are going to be. So this is a very valid approach to figure out what the capex, opex, and the commissioning cost is going to be of the project. But there are other methods too that can be used. But when it comes to revenues, things become a little bit more complicated. So let's look at that next. Revenue is equal to price times quantity. Now, quantity when it comes to generating electricity is measured in things such as a megawatt hour or kilowatt hour. So what is that? Well, the output here, the quantity, that is equal to the product of 3 variables. We have the nameplate capacity of the wind farm, how much, how we installed, how much capacity have we installed, and we multiply that with the number of hours in a year, if we are looking at the annual frequency, and there are 8,760 hours in a year. And the last thing we multiply in here, that is something called capacity factor. So one more time. The revenue is equal to price times quantity. And quantity is equal to capacity times number of hours multiplied by capacity factor. Now the capacity factor, that comes from the fact that our power generating facility, our wind farm, cannot produce electricity all the time. Sometimes it's done for maintenance, and also since this is intermittent power, we are reliant on there being sufficient amount of wind. We don't produce all the time either. So for instance, if the wind speed is less than the cut-in speed or greater than the cut-out speed, then we don't produce any electricity at all. And if the wind speed is between the cut-in speed and the rated speed, then we do produce some electricity, but not at maximum capacity. It's only when the wind is between the rated speed and the cutout speed that we are producing the theoretical maximum. So how much do we actually generate throughout the whole year? Well, the capacity factor tells us the ratio here between expected production and theoretical maximum production. So how do we figure out these variables? Price, we'll get back to that. Capacity, that we decide ourselves. number of hours in the year. You can't really do anything about that. So the only thing left here is the capacity factor, and that can be determined or estimated at least, again using regression analysis. That is something I did in a paper that I co-authored. We ran a regression on the left-hand side of the equation side, we had the capacity factor. On the right-hand side, we have things such as the commissioning year, we had the unit turbine capacity, we had the density of the wind turbine generators, we had the age of the wind farm to kind of have a proxy for wear and tear, and also the average wind speed in the area. So again, with the regression analysis, we can estimate the capacity factor. But what about price? Well, let's look at that next. Price is more about micro and macroeconomic rather than business economic, so we're kind of leaving my area of expertise. But within neoclassical economics, the price we have in a free market comes from the intersection between the supply and demand curve. Now the price can change when there are shocks to these different curves. You know, two curves, and each curve can experience either positive or negative shocks. So there are kind of four possible things that can happen here in the market. But when it comes to electricity, there are a couple of concepts that we talk about related to the price, and one of them is the merit order effect. That has to do what happens to the average price and the price volatility when we add an increasing proportion of intermittent power in the power mix. So what the merit order effect hypothesizes is that the average price will decrease as we add more and more of this intermittent power. And that has to do with the marginal cost of wind power being, in practical terms, equal to zero. While the marginal cost of, let's say, a coal power plant is non-zero because we have to pay for the coal, for the fuel. But the merit order effect also hypothesizes that the volatility of the market price will increase. So as we get more and more intermittent power, the price will start to oscillate and fluctuate more and more. So that is one thing we often talk about when it comes to the price of electricity. Another hot topic is the effect of these interconnectors, these cables that connect the power grid of one country to another country. That potentially has an effect on the market price. Due to the law of one price, prices want to equalize to each other. So if you have one country with a lower price compared to the neighboring country and you interconnect them, well, these prices will start to meet each other. And depending on the size of one country versus the other, that will determine like where do they actually meet. When it comes to the interconnectors, there's also the possibility of what is called a more short-term price and volatility contagion or spillover. So that's also a hotly debated topic. When it comes to intermittent power, such as wind power, we don't actually receive the average market price when you're generating electricity, and that is because we tend to generate electricity when the price is low. So to capture this or to kind of address this, we have several terms. One is called capture rate, another one called capture price. So capture rate is just the percentage of the average market price that we tend to receive. And capture price would be like the average price that our wind farm would tend to receive over time. Now the reason that we tend to receive a lower price than the actual average market price, that is because the output of wind farms in the same region, such as the North Sea, they are highly correlated in their output. So when the wind blows in the North Sea, then all the wind farms there, more or less, will start to produce electricity. And because of this high correlation between them, then we get a very large, significant shock to the supply curve, a positive shock, and that pushes the price downward. So the more and more wind farms we have, the lower the capture rate probably will become, everything else being equal. And that is called cannibalization. So that's another very important topic discussed when it comes to price. So that was a lot of details, but everything we have worked with so far is working towards the goal of trying to calculate the net present value of some kind of offshore wind project. If it felt a little bit theoretical, that's okay. I have co-authored a paper, this one, where the goal of the paper was to actually do a net present value calculation, an internal rate of return analysis, and payback period analysis of a real particular offshore wind project. The project we were looking at was the Dogger Bank wind farm project that Equinor is part of. When this project is completed, it will be the world's largest offshore bottom-fixed wind farm. So for more details to see how this is actually done in practice, you can read this article, because what we've done so far is essentially just the theory. Now there are a couple of additional things that we can talk about that is relevant to the pretty large topic of the economics of offshore wind. A couple of things that I did not cover in this paper on Dogger Bank that I was part of. And one thing is cost overruns. Our estimated cost is not always necessarily completely accurate. Sometimes we have cost overruns. Cost overruns is an important topic when it comes to these energy projects, because these are very large projects. They are mega projects. So even just a few percentage cost overrun can mean millions of kroner. So when it comes to wind farms, they are among the energy mega projects that are among the better types of projects. So the prevalency of cost overruns, that's both the magnitude and the frequency, it varies from type to type of different mega projects. So Friberg, who is one of the world's most renowned researcher of project cost overruns, he has compiled the world's largest database on project performance. At the time of writing in his book 2023, he claimed to have over 16,000 observations, but it keeps growing. So what he found is that the absolute worst project in terms of cost overrun, that is Olympic Games. They are among the absolute worst. Among energy projects, he highlighted nuclear power plants, as conventional nuclear power plants at least, to be the type of projects with the highest amount of cost overruns. The type of meta projects that, according to him, were the absolute best, that was wind farms. They had the lowest and lowest frequency and lowest severity of cost overruns. And he hypothesizes that's because it's very modularized project. If you're building a wind farm of 300 wind turbine generators, as with Equinor's Dogger Bank project, that is not really one big thing. A conventional nuclear power plant is one very complex thing, but a wind farm is many small wind turbines. You can almost consider them to be projects on their own. So due to this high degree of modularity, these projects tend to have very little cost overruns. Now there is a huge difference though between onshore and offshore when it comes to cost overruns. So onshore is pretty safe in terms of cost overruns, but the offshore has higher levels of cost overrun, more aligned with what we expect from other types of projects. And the floating wind farms are rather new to the industry, so there we do have a lot more cost overruns. Now another topic that we did not discuss in our paper, that has to do with the learning curve. Now the learning curve essentially says that the cost will tend to decrease as we are accumulating more experience. So for instance, we can calculate the unit cost, the capital expenditure divided by the megawatt of installed capacity. That gives us a cost per installed megawatt. Now this ratio, this unit cost, this will, according to Wright's law, decrease as the cumulative amount of installed capacity increases. So every time the cumulative installed capacity doubles, we expect the unit cost to decrease by a fixed percentage. And that is the Wright's law or learning curve, which dates back to 1936 when Theodore Wright wrote a paper about the cost of Curtiss-Wright P-36 Hawk aircrafts. And there he found a learning rate of 20%. So what we see in the offshore wind industry right now, we see that it struggles with business economic profitability. Now, the net present value is a difficult thing to deal with. So what many do instead, they simplify and use a different concept, a related but slightly different concept, and that is the levelized cost of electricity, LCOE. Now, what that is the price of electricity that would render the net present value of the project equal to 0. So it is kind of a break-even price of electricity. You take all of the costs that will be incurred over the lifetime of the project, you discount it, and you divide it by the outputted energy over the entire lifespan of the project, discounted also. So what this LCOE tells us is how low can the price of electricity be before the project becomes unprofitable. Now, the market price, as we talked about, is really difficult to predict what that's going to be in the future. So that is why it's often convenient to take out this very uncertain variable out of the net present value equation. So what we see currently, though, is that the levelized cost of energy, the LCOE, is higher, than the cost of electricity. And the question is, though, what will happen over time? Will we be able to manage to get the price or get the levelized cost of energy below the price or not? So right now is not the correct ordering here. We have prices that are lower than what we need them to be. So what can we do about that? Well, that's where the learning curve comes in. It is hypothesized that the cost will decrease over time, and then hopefully it will manage to get to dip below the actual market price. That was a lot of different concepts. We talked about a lot of different things. I hope you learned something. If not, we can try to get further into the details on some of this. Oh, and by the way, you can find the lecture note for this video on my website, industrial-economics.com, and there you will also find more details on the many concepts that I covered in this micro lecture.